Hey guys, yeah, thanks for having me. Yeah, so Scott asked me to come in and just discuss both alternative investments, syndications, um, and so I'll try to go through this presentation with you. We can make it interactive, so don't hesitate to speak over me and ask questions as we go. And if not, we'll just keep some time for questions at the end as well. My goal, like they also told me, it's a very diversified group, from beginners to professional investors. So some things might seem too simplistic, but I'm happy to dig into anything that you would like to to go deeper into. Um, and I think the goal is really just to kind of broaden your mind on the how diverse the investment universe is and how you can participate in those, and also to always think about kind of a chair with like a three leg, because the investment is one thing, but there's always some tax optimization that go with your investments, and also some asset protection that obviously Royal Solution does very well. So they all part, of the same package in a way. And when you can optimize those three things, I think you're in good shape to create wealth and to create cash flow for yourself. So just going through the motion of where when you start, when you become an adult and you go to college and people want you to get a job, and a 401k, and get a house and a mortgage, and then invest in a 401k that is going to be mostly in stock and bonds, and go through life like that, and hopefully you retire with some nest egg from your 401k. But it's usually a better way to move from that fixed mindset to a growth mindset, where learning is really not just in college, but it's all through your whole life. And it happens through schools, it happens through masterminds that you can join, it happens nowadays through you have a lot of podcasts, a lot of good resources on the internet, books, audio books, and picking an asset class that you want to learn on, you can learn a lot just by going through those motions. Also interesting to as you build wealth, you're going to build wealth by being, creating like horizontal cash flow. So we're going to talk, the vertical cash flow, which is probably either, a job that you have, or a business that you have. It doesn't mean that you cannot have a side gig, which is also going to maybe create some cash flow for you, as a small business, or, have a process to keep investing in syndication, as we're going to see, which are going to generate for you cash flow or appreciations, or both. Also, I was saying, always try to optimize the taxes and understand the why you're investing in these things. What do you need? And then, yeah, hopefully, as you build those, horizontal cash flows, after a couple of years, hopefully you can just retire early, instead of waiting to be 60 or 65 years old, and just going salary to salary every year, because that's the goal, to get to financial and time freedom. So there's kind of two phases for building your nest egg. One is investing to build that cash flow, as I mentioned, and that can be through various means, in either having your own business or going through syndications, and that compounds. The more you can generate returns on your money, and have your money work for you, the more it's going to compound. And hopefully, if you're in syndication, that gets you 20% a year, and 20% IRR over a 5-year period, you tend to double your money over that time frame. So, and then you keep reinvesting these things, and then once you have built all that, it's also not to lose it, right? Like, it's very easy to invest it in for example, last year, you were very heavily in stocks, you were heavily in crypto, your nest egg can dwindle very fast. And or you invest in a bad syndication because it was a bad operator, and that operator was just inexperienced, or faced some challenges that he didn't realize, because life and a lot of things can be thrown at you. So there's some key attributes to keep watching, and that I mentioned at the end of this slide, which are try to be diversified, try to size your trades properly, and try to have a process in which asset class you're investing in, how much you're investing, and understand your different needs, because that's what's really gonna matter, right? Like, do you need cash flow? Do you need appreciation? Do you need cash management? And within those three buckets, there's a lot of choices for you. A lot of people think when they invest, it's just 401k, whatever Fidelity or Schwab in your 401k offers you, and sometimes it's as low as 5 mutual funds that you can get over time. But know that there are a lot more choices, from private investment, VC, private equity, a lot of different bonds, alternative that you can also use for your cash management, alternative debt funds, things that people don't realize exist out there. High yield, you probably heard about, or mortgages, but there's asset-based lending, there's specialty lending, real estate, venture debt, litigation, royalties. All these things are interesting avenues that can get you above a 10% return on a yearly basis. And sometimes those funds, if you use them for cash management, sometimes they have short-term redemptions. You can just go in there, and the money market ones are going to go, you can sell them any day, to maybe 3 months, or some have 1-year lockups. But you have options also in terms of timing, depending on sometimes you have money just for a short period of time. You're going to have an investment, or a small business to acquire, or money that you were keeping on the side after the kids went to college. So all that can be managed in different time frames as well, because as we're going to see for syndications, you put your money for you have to realize that money is probably going to be stuck for 3 to 7 years, depending on the situation. And hopefully you have events that come in, refinancing, or other things that can get you at least your capital back, and then your money keeps growing, and you keep getting cash flow on a yearly basis. So don't be shy. There's a lot of things out there, and a lot that you can learn. And so alternative assets, comprise a variety of things. Also think about your retirement accounts. A lot of people, don't realize that, you can use your 401k in different fashions. A 401k is great. And the way they sell it to you when you start working is like, oh, you're going to build a nest egg, and then hopefully you'll pay taxes when you take that money out, but you'll be retired, therefore you'll be in a lower tax bracket. But I never understood that argument, because I want to be still in that high bracket when I retire. I still want to be pay in that high tax bracket, because I'm generating still revenue and money in my retirement, and so therefore first prefer
you said to interrupt you, so I'm just gonna do that. No, I agree with you, and I follow the same principle, but I feel it's tough when I give people advice, because on average people are in a lower tax bracket when they retire. Now you and we're going to be billionaire philanthropists and want to be in the best tax bracket as possible when we retire. So I'm more of the feeling of, even if I'm around the same, my guess is that taxes are going to be higher rather than lower on average. It's not going to be the same as today because of all the debt that we have in this country. So I'm on your side. I feel going to the Roth portion, going self-directed is the way to go.
Yeah, no, and you have a great point in there that, people don't realize neither, but if you look at taxes, you know, in the 50s and 60s, you know, some went to like 70%. Like right now, we're actually on the lower end of the range in terms of taxes that we paid in this country in the last century.
Go to the 20s, it was somewhere in 80, 90% with some people. But then again, the write-offs back then were outrageous. And I mean, you could be a tycoon and pay pretty much no taxes, but we'll leave that on the table.
Yeah,
So what has changed?
Yeah.
Yeah. So, you know, I certainly had a quite high W-2 income before I was retired. The other big difference is, as a retired, you know, person and real estate investor, I have a lot of depreciation options and stuff that I can use now that I couldn't when I had a W-2 job. So although I am a big believer in the Roth, it really depends on the situation at the time. And if I could take, if I could take 34%, tax income and put it into a deductible 401k and then pay 24% later to convert it, that's a win for me. So.
Yeah, and this is really just to, as I said, everybody's going to have, their own situation, and that's why I keep asking about your why. But it's just to give people options in terms of what's out there, and not only the Roth versus non-Roth, but also the self-directed, for the ability to not just be in the traditional mutual funds, but into using it for other assets. It could be a private placement company that is going to have high capital appreciation. It can be a real estate syndication, although because in real estate syndication, and we'll see it later, you get depreciation. I tend not to use my 401k unless it's a low asset depreciation, in which case it works well. So just know that you have those options out there, something to discuss with your accountant, your financial coach, or whoever is helping you out there. And so, Brandon was just talking about, the tax consideration, and there are choices for even high W-2, Brandon. So, the best one for people who are in the high W-2 bracket is to have your partner and your spouse become a real estate rep. So that will get you the biggest bang for your buck. If your spouse,
a real estate rep, you mean a real estate professional, don't you? Professional status.
RE,
yeah,
real estate professional.
Yeah. And so, and that's because if your partner doesn't have a W-2 and gets that exam and becomes a real estate professional, you will be able to take the depreciation losses that you get from your investment in real estate, because it's real estate depreciation, usually they go just against your passive income. But in this case, because your partner becomes a real estate professional, that's what he does as a profession. Therefore, he can take the other income that the family gets through real estate can get against that W-2 income. And again, he doesn't have to take the exam. Your CPA, and again, I have to this is everything that I'm telling you here is no tax advice. It's not investment advice. I am not an IRA. I'm a registered Series 7, but so just take everything I do, that's the disclaimer, with a grain of salt, and always consult with your advisors, financial and CPAs. But your CPA can decide, let's say you have a couple of short-term rentals that you're managing for the family. Your CPA can make your partner give him the real estate status if he can justify that they have worked about 750 hours a year on your short-term rentals, manage all that for the family, and therefore you can be a real estate professional without taking the exam. the other thing that you can do for depreciation for high W-2s is in oil and gas ventures. So it's a little more risky because you have to be a GP, a general partner in those syndications, at least the first year, and then they move you into an LP. And being in a GP, you know, there's a lot of risk. So, you know, be careful, ask people who've done that before, ask again your advisors about it. But the government gives some special tax treatment to those investments because they want to encourage, you know, oil and gas generation in the country, and therefore, because of that, you can take the depreciation that those syndications get you and get them against your W-2. So those are really the two biggest ones that you can use if you're a W-2 person. Now, there are other ways to save on taxes. We just talked a lot about, you know, real estate depreciation. You know, there are, you know, car allowances that you can do if you buy a new car. If it's a green car, you can also get $7,500 as a tax deduction to it. So if you're in the lookout for a new car in 2023, I think you can still use you know, those car allowances. If you run a business, you can put it, you know, on the business and get those depreciation for against your taxes. There's a lot of solar, depending on the state, investment tax credit you can get as well. And then, you know, you can also be tax efficient by, you know, if you have a real estate investment, you know, it could be a long-term rental or short-term rental property, for example. If you have it as an investment, you can move it the next time you're going to sell it. Instead of paying taxes on the appreciation, you can just take that money and reinvest it in another property. And it could be any type of property, anywhere in the US. You know, you can, even if you're in short-term rental, you're moving into a commercial property, you can do that. By doing that, you don't have to pay the tax on the appreciation. You have your full amount of money that keeps working for you over the years. The other way, you know, people have sometimes capital gains. Let's say you had a private investment in a private company, and that company sold out or IPO'd, and you got like a fresh amount of cash, or you sold your company and you have you know, tax gains. You can use you know, opportunity zones and invest in a real estate syndication that is in an opportunity zone. In which case, same thing. It's a very flexible. It's even more flexible than a 1031, because a 1031, you know, you need to have an intermediary. You have very strict deadlines. You also have deadlines for opportunity zones, but you know,
You're saying an opportunity zone is more flexible than a 1031?
Well, in the sense that you don't have to go through an intermediary, but it's not flexible in the sense that you have to stay in that opportunity zone for 10 years. So your money is stuck for 10 years. But again, that doesn't mean that there can be an event. Let's say there's a refinancing after 2 or 3 years, or you know, your syndicator the same way in a traditional syndication can get you your capital back, you know, not after 10 years, but after, you know, 2 or 3 years. So just keep that in mind. And they manage not to be taxable because they have also depreciation that are running at the same time, and that, you know, as you get that money back, they have the depreciation that goes against it. So they can show you that you're still eligible for not paying the taxes in the opportunity zone that you're in. Anyway, so just know that there are options for you to invest in a tax efficient way. We mentioned a couple, and, you know, happy to open it up afterward to two more. So, you know, the purpose of this call is also to just go a little deeper into a syndication. What's a syndication? It's basically just pulling, you know, capital from various investors into a project, and that project is going to be run by a GP, a general partner, or general partnerships, where there'll be, you know, multiple partners, and you can invest in that as an LP or as a co-GP. Usually, if you want something passive, where, you know, if you have your own short-term rentals, it's work, right? You have to deal with tenants. In multifamily too, you have to call the people to go repair the boiler that went down. There's all kinds of stuff. The beauty of going into syndication as an LP is that you have the general partnership that will manage all that for you, and you will just get hopefully a nice coupon every year, and then some capital events happen again, and then you continue to generate cash flow, and at some point they'll sell it, and they'll sell it with some good appreciation, and you'll hopefully get a strong return and IRR to your investment. There's two types of syndications. Nobody wants to go and register with the SEC, so they use the exemption rules, which calls for either going into a 506B or 506C. So if you heard that, you know what it is. It's just basically a different way to raise money for those syndicators. The 506B is going to allow to go to raise an unlimited amount of money. It's going to allow up to 35 non-accredited investors. But the difference between 506B and C is that it's in the number of accredited investors. It's also in the ability to advertise or not. So it used to be that 506C was the highest percentage of the syndications that were coming out. Nowadays, because of the internet, because of everyone wanting to advertise and market themselves and raise money, 506C, which are mainly for accredited investors, and we're going to go to it in a second, are getting more and more, crowded in the type of raise that is going up. So being an accredited investor means that you either made $200,000 a year for the last 2 years, or you have $1 million in net worth, not including your primary residence. And there's also some syndication sometimes for outside of real estate, mostly where you need to be a qualified purchaser, and that's for people who have a higher net worth, even a higher net worth, and at least 5 million in investments over in their portfolio. And the way the syndication is going to be the good news is that it allows you for a low amount of money, not a low amount, it's still like, usually 25 to 50 grand minimums, which, is a lot of money, but, instead of going and having to buy something for $1 million, you can participate to that investment at a lower minimum. And so you're gonna go through that. The GP is going to send you what they call a PPM, which is a private placement memorandum, which will have all the information you need about the deal, how the deal is going to work, the business plan they're going to send you as well, the operating agreement, the subscription agreement that you're going to sign. That's going to really be the legal document that manages the relationship between you and that syndicate. And then, normally you'll go to an investor portal where you will get, every now and then some updates about the syndication and how your investments is going. You will also get your yearly coupons, through that investor portal where you'll put your banking information and all that, and that will be, where a lot of the information comes to you. So, syndications are great, as I said, because you can go passively and you can go at lower minimums. But now that doesn't mean that it's you don't have to do your homework. Like everything, any investment you make, you need to spend time, you need to do your homework, and know your why as well, right? Like, are you looking for cash flow? So I have friends and investors, they kind of want to retire early, therefore they quit their W-2. They have some side gigs, but they also use syndications to generate cash flow. So they do need high cash flow syndications that are gonna, every year give them a little bit of cash flow, so they can, they can count on that cash flow to survive. And so, depending on the syndication you're in, they're gonna pay you between, 3 and 10% coupon, and but usually the ones that don't pay a high cash flow will tend to pay you. You have bigger upside on the back end, and therefore that's what if someone is looking for. Let's say you're very wealthy, you're just trying to put your money and grow that money over time. You prefer appreciation to cash flow. Then there'll be different type of deals for you, right? Also, do you need larger depreciation and tax advantages? So some people, just because they have they have a lot of short-term rentals, they have a lot of passive income that is coming in, they're going to try to reduce their tax liability, and therefore they'll be looking for deals that have high tax advantages. Are you looking for diversification? So if you're trying to find in your portfolio of things, I think diversification is one of the single truth of investment as well, because you don't always have all your nest in the same, your eggs in the same nest. And so that diversification, some people want to be diversified, some people want to be concentrated. But if you're looking for diversification, just share with either your investor group or your investor coach or your CPA what type of investment you're looking for. If you're looking, I don't know, for a commercial real estate, because now you have a lot of residential real estate. Maybe you're looking for an oil and gas, because you're a W2 high W2 income guy. So know your why, and then narrow down the investment that you will need. And then obviously that's where the hard part. Once you have decided what type of investment you want to do, you're going to have to start doing your due diligence. And that's where joining an investor club or having a mentor or having a financial coach can be helpful, because they will help you. It's hard to understand how to vet a deal. They'll send you maybe a spreadsheet. Maybe you're not very good with spreadsheets to understand the cash flow. What's the difference between an IRR and ARR? So there's all the financial side of things with what they call the pro forma and the Excel sheet, but there's also vetting the operator, right? Like a lot of the time, first when I invest is also going to be first for the operator, because I want someone who has experience. I want someone who's specialized in the asset class that I'm investing in. I want to know the character of that thing. Does he have grit? Does he have resilience? Did he face, what's his history of investment? What is the history of returns he had on in the past? What's his net worth? And then you want to vet his team as well. You want to understand, does he have a good investor relations team? And that's important. You'll see it, because once you invest it, those investments can be 7 years long, right? You need to understand, are they going to communicate with me? Are they share information, or am I going to have to go and every time try to get that information from them? All these things are important to feel comfortable to sleep at night and understand that the $50,000 that you worked hard for is going to work for you and not become like a liability or lose it because the operator didn't know what he was doing. So there's a lot of due diligence checklists, like anything. I think a checklist is a good way to proceed. I put some bullet points here of some of the important ones, questions to ask. And again, when you join an investor club where you have an investor coach, they will help you, draft those questions and talk to the operators. Join the calls when they offer you to meet the operator and ask those questions. Even if you don't the first couple of times, even if you're not going to invest, just join the call, because you learn to hear the questions that are being asked, the type of assets, and that due diligence is really, really important. And then as you specialize, as you start getting more comfortable with investing in different syndications, different asset classes, as I mentioned here, there's a couple, it could be a mobile home park, it could be a self-storage, could be an oil and gas, could be a triple net lease retail strip, it could be a marina. There's so much out there that you can invest in. but that also means your education needs to catch up, right? Like there's very different questions to ask if you're invested in a triple net lease syndication versus being in an oil and gas syndication. And each one is a full-time job in itself. So we don't expect you to do that. That's why I'm always supportive of, finding a mentors, finding people who did it before, finding, reading books, listening to podcasts, having a financial coach. You think it's expensive, but missing out on a good syndication or investing with someone who's going to lose your 50 grand is going to be a lot more expensive than the learning curve that you have to go through. So, or the masterminds or the coach that you're going to pay for. And a lot of the time, by being in those with those networks, they will introduce you to that network. They will raise a lot of the issues that you need to be aware that on your own, it's who not how. If you haven't read that book, I highly recommend it. Same thing. They'll share books, they'll share podcasts, they'll share all kinds of things that might help you in your journey to become a great investor. And again, syndication in real estate is one thing which I'm over focusing on, but keep your mind open. There's I'm invested in private placement, in coffee companies, in SaaS companies. I have some private equity money with some private equity funds. There's a lot out there, and again, depending on who you are, what you're trying to achieve, you'll be able to do that by understanding. It's all about it's continuous education. It's having that growth mindset that will get you closer to being a savvy investor. I just put it out there. That's a little bit of an outlier, but I know that a lot of people who are looking for financial freedom and time freedom, they also want to quit the W-2, and a lot of the questions that come out of sometimes on healthcare. So I just thought that I'll throw some healthcare hacks for you here, because it's tough. When it's not sponsored by your firm, healthcare can be expensive. So I give you like here 3 options. One is, if you're you start being a savvy investor, meaning you're getting good income and good cash flow, but you're also getting good depreciation that reduces your gross income. That's what the Obamacare plans are looking at. They're going to look at what they call the modified adjusted gross income. And I know some real estate investors that actually pay 0 taxes because they have so much depreciation from their investments and passive or active. And therefore they go on Obamacare, and sometimes they actually get the lowest of the lowest Obamacare plans, meaning they're able to get the best plans at the lowest cost because their adjusted income is really low. The other option that you have, health share plans. Some of the ones that some of my friends are in are MediShare or Zion Health or Christian Share. You can go and check them out. I'm happy to talk offline on preferences and whys. And then another hack that I did is you can go and there's a lot of online master programs out there now, or even like any online program. You can join your university, take it part-time. You have 5 years to finish it, so you can just pay like 1 course a year or 2 courses a year and benefit from the low-cost healthcare plans that they have. So that's another great hack. So I'll stop here. I think I've been talking for a long time. I think I said a lot of things, and let you answer some questions if you need. I'll put my contacts in here if you need to reach out to me.